All right, let's just jump right in. Every now and then the market does something that makes everybody, and I mean everybody, stop and just stare. Today, we're going to tear apart one of those moments, a really jaw-dropping surge from one company, VCE Health Inc. Just look at this number for a second, 93.57%. That's not a yearly return. It's not even a monthly gain. No, that is what one stock did in a single day. A move so explosive, you just have to ask, what happened? And this incredible move belongs to VC Health. On October 21st, its stock didn't just climb, it absolutely erupted. And what makes it even crazier is that this came after a pretty wild period where the price had actually sunk to just 45 cents only a few days before. So you gotta ask, right? What in the world is going on here? Was this just a flash in the pan, or is it the start of something big? Well, we're going to break down the technical analysis from the source report to really understand the anatomy of this breakout. All right, first things first. In any mystery like this, the number one clue is to follow the money. Or, in the stock market's case, you follow the volume. So let's take a look at the numbers. So, get this. In the 10 days leading up to this explosion, the average trading volume for VCE was about 27 million shares. Think of that as the normal, everyday hum of activity for this stock. That's our baseline. And then, boom, on the day of the surge, the volume just skyrockets to 263 million shares. That's nearly 10 times the average. I mean, that's not a subtle hint. That is a giant, flashing neon sign that something huge is happening. So how do analysts read a massive spike like this? Well, the source report says a volume explosion usually signals one of two things. Either the big fish, the institutional players, are jumping in with massive buys, or you've got a short squeeze, where people betting against the stock are forced to buy back shares, just pouring gasoline on the fire. Okay, so the volume tells us that a party started, but the technical indicators, they're what tell us if that party is going to keep going all night. So let's move on and see how the case for the bulls gets built here. To do this, analysts use tools called trend strength indicators. Honestly, the best way to think of them is like a power meter for the stock's momentum. They're designed to answer one simple question. Is this trend for real, or is it just a bunch of noise? And in VCE's case, oh man, that power meter was lit up like a Christmas tree. The price just blasted above key short-term averages. The ADX score, which is a really important trend metric, was sitting at a super strong 32.68. The positive directional indicator, that's upward pressure, was just crushing the negative one. And the cherry on top, the MACD histogram flipped positive, which is pretty much the classic textbook signal for traders that momentum is now on the bull's side. But, and there's always a but in the market, right? This is where the story gets a little more complicated, because no rally, no matter how powerful, goes straight to the moon forever. So the very next step for an analyst is to start looking for signs that the move might be running out of gas. For that, they turn to something called momentum oscillators. And I love this analogy. Think of these like your car's tachometer. They measure how fast the price is moving. And if you rev that engine too high for too long, the needle pushes into the red zone. In trading, that red zone is called overbought, and it's a huge warning sign that you might need to ease off the accelerator. And let me tell you, these tachometer is definitely screaming in the red. The relative strength index, the RSI, is just a hair away from that official overbought level. The stochastic RSI is at 100. It literally cannot go any higher. And other indicators, like the Bollinger Bands and the CCI, are also flashing warnings, basically saying, hey, this thing went too far, too fast, and it might need a serious cool down. So this is the whole story right here, this fundamental conflict in the data. It's a tug of war. On one side, you've got this immense bullish force, confirmed by all that volume and trend strength. But on the other side, you've got these clear signs of exhaustion risk, suggesting the whole move is stretched way too thin. This is the central tension analysts have to wrestle with. So what do you even do with all this conflicting information? Well, you don't guess. You identify the key price levels that are going to act as the referee in this match between the bulls and the bears. These levels are the lines in the sand that are going to tell us which side is winning. And the analysis lays out the battlefield really clearly. The next open is estimated around 80 cents. The first major floor or support level is sitting at 83 cents. If that gives way, the next line of defense is down at 67 cents. Now, looking up, the ceilings, the resistance levels, are at $1.11 and then a big one at $1.15. How the price reacts at these specific spots is going to dictate everything that happens next. And now we get to the synthesis. This is where it all comes together. We've got the volume, the bullish signals, the overbought warnings, and the key price levels. Based on all of that, the analysis outlines 3 possible futures for VCE. So, the most likely scenario with about a 65% probability is a bullish continuation. This is what happens if the price can stay strong and hold above that key 83-cent pivot point. The second scenario, with about a 25% chance, is consolidation, basically a timeout, where the stock just trades sideways for a bit, letting those overheated indicators cool down. And finally, you've got the long shot, only a 10% chance of a bearish pullback. That's if support breaks and the profit takers finally get control. So, to put a bow on all of this, the whole story the analysis is telling is this. We saw a legitimately powerful, massive trend reversal, backed by some serious conviction. But that move was so violent, so fast, that now it's facing a critical test to prove that it can actually last. And this just perfectly captures the drama of the market, doesn't it? It's a high-stakes standoff between pure bullish conviction on one side and overbought exhaustion on the other. All the data is laid out on the table, but the final outcome? That's yet to be written. Looking at all this evidence, which future do you think is the most likely?